Hey guys, welcome back to the channel. My name's Max. My channel's name is The Covered Caller. It's Saturday, so that's my favorite day of the week. For one thing, my Oklahoma Sooners play football. And for another thing, it's time for the daily top 20 high yield ETFs of the week according to the Max Factor. Now, what is the Max Factor, you might ask? Well, Max Factor is my own proprietary metric that I made because I don't think traditional Wall Street has a very effective way of measuring these funds. Yes, you can look at total return, but total return can be deceiving. So I've taken the good elements out of total return and turned them into my own metric that I think is a more fair way to compare these high yield ETFs to each other on more like of an apples to apples basis. So we're going to do the show a little bit different this morning. We're going to still the top 20, but we're actually going to show the top 50. All right, so here we are at number 50, RSPA. This one's yielding 8.5%. This one's based on the equal weighted SPY. Sales covered calls on the equal weighted SPY. Then we have T-SPY. This one is from our friends over at Tap Alpha. These guys do a great job, yielding 14%. Then we have EGGQ. This is from our friends over at Nest Yield. This one pays about a 5.5% yield. Speaking of friends, we have our friends over at Curve with KQQQ, yielding 9.6%. That's called the Kings of Tech. Sells covered calls and other things on tech stocks. Then we have Will at number 46. We have FTHI. That's from First Trust. That one's been around forever. That's a granddaddy covered call fund. I think it came out in 2013 or 14. Anyway, then we have TS2. This is based on Tesla. It's from Rex, yielding 55%. Then we have Triple QI, yielding almost 13%. This is a really good fund also from NEOS. And then we have IVVW, Triple QX, and IWMI rounding out the top, or from 40 to 50. Now let's go down and look at the rest of these. 39 is WEEI. That's based on the energy sector. Tuggin is a really good fund that no one ever talks about, yielding about 10.5%. STRC, this is actually a preferred stock, but it pays a yield. It pays a high yield, about 11.29 lately. Then we have ASGI. This is actually a closed-end fund, and we talked about it last night on my show, The Daily Factor. We looked at all the closed-end funds that are on this list and compared them with each other. Next, we have SPY from NEOS. This is another really good fund. This is the brother fund of Triple QI. Then we have CAIE from Calamos. This is based on auto callable bonds, super steady and pays a nice yield of 12.39%. GPIX and GPIQ are next. They're both from Goldman Sachs. GPIX is based on the SPX. SPX has a little bit less volatility than the Qs or the NASDAQ. So the GPIQ is based on the NASDAQ. It pays about 15 or 20% more yield, but these guys both do a very good job. Then we have double QA. Now this one's based on the equal weighted Qs. So this is a more of a defensive type play. You don't overweight in all the tech stocks. For instance, QQQA doesn't have 8% in NVIDIA. They only have 1% in NVIDIA. They take the Qs and they equal weight it. It's a more defensive type strategy. All right, then we have SPUT coming in number 30. We have CanQ. Now this one's from Calamos also. This is a hedged equity fund that also pays a little bit of a yield, 5% yield. Then we have JEPQ from JP Morgan, yielding about 10.5%. That's a good steady one. Then we have Devo and iDevo next. They're right next to each other, yielding about 5%, 4.5 to 6%, 4.5 to 5.5%. They're both super steady, and I know a lot of people that like those. Big Y, and speaking of super steady, Big Y is a really good fund from YieldMax. YieldMax may not be known for their NAV steadiness, but this one is an exception to the rule for sure. It pays about 10.6%. It's actually a target 12% fund, and that's actually what gives its stability. Is it doesn't try to pay out a maximum yield. It only pays out 12%, so the rest of the money can go to protect the NAV or it can go to the upside, basically. All right. 24 is QYLG from Global X. 23 is TDAC also from Tap Alpha. So T-SPY and TDAC are on here. These guys do a good job. Pays them almost 14% yield. Number 22 is that's based on the bond market, yielding about 12%. Then we have SOXY based on semiconductors. This is also a target 12 fund from YieldMax. And it's only yielding 10.4 right now on a trailing 12-month basis, but they try to target about a 12% yield on that one. Gets a lot of NAV upside. You can see for the quarter, it's up 5% on NAV, and it paid a 10% yield. So that's pretty good. That is pretty good. All right, then we have Bond I. This one is from Neos. It's based on the bond market. And then we have TLTI, also based on the bond market, yielding 6%. Let's look at the NAV. NAV's up 3%. That's not bad. You got a 6% yield. The stable dex over here is the relative stability to the market. The market is a stability of 1. It's indexed to 1, and 1's market stability, meaning the S&P 500. So this is about 50% more stable, less volatile, however you want to look at it, than the SPY. All right, number 18 is SPIN. Now, this is from State Street. Now, State Street invented the index ETF. They came out with the SPY, I believe, in 1993. And that's definitely the greatest financial invention of my lifetime, maybe behind the listed options. Listed options came out in 73 in Chicago, but other than listed options, I would say the index fund was the greatest financial innovation of my lifetime. In fact, the index fund's better than listed options even, probably. It's helped more people even. That index fund has a lot of use cases for a lot of people. All right. Number 17 is Y Gold. This one's based on gold. It's yielding about 9.2%, but look at this list. It's got 19% NAV upside. The NAV's gone from 34 90 days ago to nearly 41. Now, it's not super stable. It's only about a third as stable as the broader market, but I mean, we'll take it. Y Gold's a good looking fund. Number 16, TSLP from our friends over at Curve. Now, this one, it writes covered calls on Tesla in the monthly time frame, pays a reasonable yield, but also gets a reasonable quarterly NAV return. Now, the quarterly NAV return does not include dividends. This is NAV only in this column. And the yield is based on a 12-month yield. So, but you could take a fourth of that and you could figure that it pays about 9% a quarter, and it's received, and it has about 5% NAV upside. So this quarter, it's probably has a total return of 10, 12% or something. You extrapolate that over a year, and this could be a 50% total returner. Now, it's dependent on Tesla. It depends on what Tesla does over the next year. But in any event, number 15 is TLTW, also based on the bond market. The TLT is a bond index. TLT is the SPY of the bond world, basically. But in any event, this thing has a little bit of NAV upside, but it paid a really decent yield. Coming in at number 14, we have APLY. Wow, this one's yielding nearly 35%. The NAV's gone from 1335 to 1367, so the NAV's up about 2%. It's about 3/4 as stable as the broader market. That's not bad. Then we have AMDW. Now, AMDW pays a 72% yield. It's based on AMD. Now, they don't use options. They use something called a total return swap. Well, total return swaps, the way that Roundhill uses them, this is a Roundhill fund, does really well on the upside. Maybe not so well on the downside. We'll see. We really haven't had a serious downside market since these total return swap funds have been out. But in any event, it's doing well. Now, the knock on this fund would be the stability. It's about 8 times more volatile than the broader market, or 1/8 as stable. All right, number 12 is QYLD, yielding about 10%. Good job, guys. Has 5% NAV upside. We'll take it. Number 11 is XYLD, yielding about almost 11%. Has a little bit of NAV upside. These are both from Global X. Super stable. Look at XYLD stability. It's almost twice as stable as the broader market. Number 10 is Silvo. This one is based on the SLV, which is a silver ETF. And this one does a nice job. You have almost 20% yield, and you've got some really good NAV return this quarter. The NAV's gone from 84 to 90. That's not bad. It's about half as stable as the overall market. Number 9 is K-Gold. This is from our friends over at Curve, yielding 10%, and it also had 18% quarterly NAV return. That's really good. That's a lot of NAV return. All right, number 8 is XYLG. Now, I always talk every week. I say this one has an asterisk next to it because they paid a one-time special dividend that I don't believe they're going to pay again this year. But it is cool to have this fund on here. The reason it paid a one-time special dividend, well, there's a couple reasons. First of all, the strategy of XYLG, it does the same strategy that XYLD does. They're brother and sister funds, basically. But XYLG under normal circumstances only pays about 5 or 6%. And why is that? Because they don't write as many options as XYLD. XYLD writes options on the entire portfolio. XYLG just writes options on about half of the portfolio. What that means is they get a little less yield, but they get more NAV upside because they have half the portfolio that's unencumbered by options. It can grow as much as it wants. Well, that's the other part of the equation. 2024 was a great year for the S&P 500. I believe it was up 28% or something. Well, in any event, these guys are halfway uncovered on something that was up that much, and they had a huge capital gain. And at the end of the year, they had to pay that out to shareholders. ETFs have to pay out 90% of the money they make by the end of the year, or they suffer a tax consequence that they don't want to suffer. So in any event, the caveat on this one is it probably won't pay out 22% on a regular repeating basis. It pays about 5 or 6%, but it does get extra NAV upside. So that can be a good alternative for you. All right. Then we have XLVI. This one is from State Street. It's based on the XLV, which is the healthcare index. And this thing has been on fire. This only came out, these State Street funds, they call them the sector funds. They came out the last day of July. So they haven't been out super long, but man, they picked a good time to bring this fund out. Now this chart that I'm getting ready to show you is NAV only. This chart doesn't factor in the dividends. This is not a total return chart. This is a NAV chart. Looks like they came out around 25 bucks a share. Yeah, they did. They came out, they introduced them at 25 bucks a share, pulled back, the first couple of weeks, they dropped down to 24, but then since then, the XLV's been in a huge rally. This thing only has 4.5 million under management, but it's a decent way to get partial upside and partial exposure to the healthcare sector, and also, pay yourself a yield. All right, number 6 is GLDI. Wow, this one's based on gold, yielding 15.06%. NAV is up 5% on the quarter, and this is stable. It's about as stable as the broader market. That could be a good one. IAUI, also based on gold. You're seeing a theme here. Everything's gold and silver. Anyway, this one pays about 10.5%. It had really good NAV. The NAV is also on the quarter up 10%. That's really good. Now, it's a little bit less stable than GLDI, but it also had a little bit better NAV return. With risk and reward, you can't get away from them. You can buy a super stable fund that can be too stable. You can buy a super risky fund that may have a higher yield or a higher NAV return, but it may be too risky. The max factor tries to identify the best compromise. But all right, number 4 is Goop. This is from our friends at Curve. Now, this is a good one. Pays a 12.4% yield. It's based on Google. The NAV for the quarter is up 25%. Great job. Number 3 is iGold. Wow, look at that. iGold is based on gold. It's based on the GLD, which is a gold ETF. NAV's gone from 21 and change to 25 and change. That's really good. 70% NAV upside, and it's paying you a 15% annual yield. Number 2 is GUI. GUI is also based on Google. Quarterly NAV return of 11%, but it's paying a 40% yield. We can look at GUI compared to Goop. So GUI pays a higher yield than Goop does. Goop uses monthly options. GUI uses weekly options. Weekly options pay a higher yield, but they're also riskier. We'd expect to look at the stable decks, and I would expect GUI to be less stable than Goop. And it is a little bit less stable. Good job. And then number 1 is GOOW, also based on Google. This one's from Roundhill. Man, this thing's incredible. price 90 days ago was 52 and change. The price Friday was nearly 71. I mean, you're getting yield, you're getting NAV upside. Now, granted, it's not super stable, but I mean, heck, it's only based on one stock. So what do you expect? Let's look at GOW. This is a good looking fund. This is from Roundhill. These are the guys that use the total return swaps. I would expect these to not do as well as the covered call funds on the way down. A true covered call fund creates a small downside buffer. And so I would expect the covered call funds to do a little bit better on the way down, but something that uses total return swaps. And also, not only they use total return swaps, they also use a little bit of leverage. So this one's built for upside. And man, they've got some upside. They're still dependent on Google to go up. Google has to go up. But I mean, if Google goes up, these guys do a great job, has 75 million assets under management. Okay, let's take a real quick look at some of the other ones on the list. Let's just go to the bottom of the list. Now, these funds right here aren't necessarily bad funds. Maybe a couple of them are, but they're based on underlines that are having a rough time. So what do we have? We have Bitcoin, XBTY, MicroStrategies has been doing poorly. MSTW, that's based on MicroStrategies. ULTY has struggled this quarter. A lot of it has a lot of Bitcoin and Bitcoin adjacent meme type stuff. And Bitcoin is down 30% in the past month or so. Anyway, Maro, that's based on Bitcoin, SMCY, iMaro, AIYY, Coney, and ULTY for that matter, this summer, when their underlines were doing great, they were in the top 20 on the max factor. But their underlines have taken a turn. Like I say, Bitcoin's in a bear market. So a lot of these that are based on Bitcoin or Ethereum are down here in the bottom of the max factor. All right, guys, we'll tune in next week and we'll have another show. Every Saturday is the max factor. Now, remember, not financial advice, consult a professional advisor. Now, also remember, if you like this kind of content and you want to give me a tip or support this station, you can go to paypal.me/Max Convexity. Guys, I appreciate it very much, and I hope you have a wonderful day. Talk to you later.